Good afternoon, everyone. Anthony Iser here with another ITPM Flash. Well, my DMs are full, not with love letters and invitations, but with questions from all our friends in our Discord channels asking what's going on with markets today and who is this guy, Fed Governor Waller. So today it's after market, it's Tuesday the 16th of January, and I'm going to talk to you about the what, the why, and the how of what's going on with Fed Governor Waller, markets, the macro outlook, and how I'm going to play it. But firstly, let's start with what. Fed Governor Waller has come out today and toned down his entire narrative of lots of rate cuts to come. He first started talking about this late last year, and it was much of the driver of the strength in the market. That strength came from the change in consensus, or the upgrade to consensus, to very strong soft landing views. We saw multiple expansion as the market looking forward, expecting earnings to change and come through. The consensus is very much soft landing. You can see that on this chart here. Bloomberg articles talking soft landing left, right, and center. You can also see the dark blue lines, which indicate a recession. So soft landing usually precedes a recession, and that may be the case this time. And that's part of the why that it's important. But let's stick with the what for the moment. Let's stick with consensus. You can see here on this table that 79% of fund managers surveyed by Bank of America are expecting a soft landing or no landing. So that is very ingrained in everything that we're looking at the moment, ingrained in market expectations, reflecting in valuations and market multiples, and it's also reflected in the rate environment outlook. The outlook is for cuts. Goldman and Barclays expecting cuts as soon as March, and the number of cuts is expected to be somewhere between 4 and 6 this year based on market forecasts. That is going to be really important for the strength in this market, because that strength is going to require underlying earnings growth to come through to be reflective of this narrative, to see upgrades to this narrative. You can see on this table here, the yellow lines at the end, the yellow bars, consensus forecasts for earnings are starting to tick up. With the earnings season kicking off now and running for the next month and a half, we're going to need to see those numbers being upgraded. So beating expectations, upgrading forecasts in order for this narrative to keep holding through. Disappointments on that front are going to change the narrative. The price of markets will change that narrative. There will be a fear of a hard landing coming through. Whether a hard landing comes through or not is a question for further down the track. But we need to see strong earnings coming through. So that's something I'm going to be very, very focused on. The reason why the Fed consensus and interest rates are so important at this point in time is because as we look out over the next 12 to 24 months, there's two main paths that the economy and markets can take. And one is this soft landing approach that is priced in at the moment, and the other is a hard landing and a recession. And what the Fed does over this next little while is going to be a key determinant of which path we go down. If they can manage this soft landing, if they can lower rates, get the economy balanced without tightening any further, balancing the quantitative tightening that they're doing with rate cuts coming through, letting the bond market do it, we might see those earnings upgrades continue to come through and a new bull market taking place, with this recent period just being a mid-cycle slowdown. However, if rates are too high for too long, the Fed will break something and will move down the hard landing path. And the reason why for us that's so important, because the divergent in market price outcomes is huge. So instead of seeing a 10 to 15, 25% growth in markets over the coming year, a hard landing would see sizable downside. Historically, 23.5% is the average for hard landings, as this table shows. And interestingly, from the time the Fed first cuts rates through to when that market bottoms, the average is 195 days. And in two cases, it's been longer than a year. So that hard landing path is a pretty long and grim place to be. The key thing is we don't want to go rushing off down one of these paths only to find that we've gone down the wrong one. So that brings me very much to the how. How do we play this? How do we stop running down one path? Well, one thing is we want to sort of rein those big outsized moves in. I want to be net long at the moment. And the reason for that, as you can see on this chart here with this, this box, the Fed pause, and when the Fed stops raising rates and pauses until they start cutting rates, historically has been a bullish time for markets because we're in the Goldilocks soft landing period. Earnings are ticking up, unemployment stays low, the economy looks like it's going okay, and there'll be pronouncements that the Fed has achieved something that is very rare, a soft landing. In fact, if you're looking further at this table, you can see there's only two soft landings, only two periods where the Fed funds rate was cut, but we didn't see one of those recessionary periods. And that was in 1966 and 1995. And so for the narrative of this time it's different, we need to sort of fall into one of those camps, why that might have happened. 1995 is one that could hold true. In 1995, that soft landing was very much driven by productivity gains that came through from the boom and the start of the internet. Things as simple as an overseas transfer for a bank account used to cost $5. It quickly dropped to a fraction of a cent. Those types of productivity gains are flowing through all businesses, leading to outsized margins, outsized profits, and outsized share market gains. However, everything reaches a point where the Fed raises rates too much and too long, tightens too hard and breaks something, which they did. Come 2000, same thing happened. And it's happened multiple times over this last 60 years, as you can see there with those dotted lines. So at this point, I want to remain net long. But this is not crazy net long. This is just net long, willing to be nimble and willing to be patient. Because once the Fed starts cutting rates, those dotted lines there is a time that we must accept that there's a very strong likelihood that they've broken things and they're not going to cut rates 2, 3, 5, 6 times like the current forecasts are, but they'll actually cut rates 8, 9, 10 times, sometimes maybe cutting 50 points in a day because they've broken something. And you can see the steepness in the declines of these Fed funds rates cuts through these recessions when they've done it. So for the time being, I'm going to be net long, I'm going to be patient, but with one eye to seeing when the Fed actually starts cutting rates. And that could be 12 months away. I think Goldman and Barclays would be reviewing their decisions now and potentially saying, we're a little early, let's push it out a bit. We don't know when that'll be, but let's just wait. The most important thing, though, I think, with all of this is if we have strong, fundamentally driven idea generation process, we have a long-short portfolio, we have risk management, trade management, we have the ability to be nimble, we can be quite agnostic towards this macro environment. And that's the advice that I've been giving our friends in our ITPM Discord channels, is what we want to do is try and be patient. So asking them to go and look at it, make that assessment for themselves, but suggesting be patient, make a focus on your fundamental idea generation, your risk management, your portfolio management. And by doing that, you can be reasonably agnostic about market direction. There will come a time when you want to thump the table and say, I'm going to be very long or very short, but that time isn't now. So there we are. That's where I'm going to be playing it. I'm willing to be standing here in a month's time and change that view. But that's the most important thing with all of this, is to be willing to accept that the situation's changed. So let's see what the rest of the Fed governors do. Let's see what the investment banks do, whether they start winding back those expectations of rate cuts. I would think rate cut expectations might start to change a little bit over the next month or two. However, earnings season is going to be really important, because if it's not strong, then those rate cut expectations will build up again. But they'll build up from the point of view that something is broken and we need to cut rates really hard in order to try and fix it. So good luck, all the best. I'll talk to you again sometime soon.